So hello and welcome to Conversations with Esther tonight, 7th May 2025. I will share some slide here to kick off. Yeah, and I hope you can see my screen there. Yes. So allow me to pray. Father, in the name of Jesus, we thank you for this session. We pray that you will lead us and guide us. We pray for our presenters that you will bless them and give them favor in Jesus' name. Amen. Amen.
Amen.
Good. So I will introduce you to Conversations with Esther. This show is hosted by Conversations with Esther. Apologies, a few issues with the camera, but it will be well for me. So Conversations with Esther is an impact-driven professional platform that informs, educates, and rebuilds mindsets on matters work, organizational culture, and holistic wellness. Now, we ignite ethical and authentic leadership, promoting best practice within industries. Conversations with Esther equips the workplace with relevant legal, human resource, and holistic wellness skills through capacity building, training, motivational talks, end-to-end HR consultancy support, and mentorship programs. Guided by our three values, integrity, excellence, and impact, we envision a workplace transformed by professional conversations and respectable relationships, and intentional leadership. Now, we are very vocal on wellness in the workplace, and we remind you that self-care is not selfish. Now, we help organizations structure wellness programs. We train organizations on wellness. We speak to your staff on wellness. Kindly let's mute. Kindly let's mute. Silence, help me mute the people. Thank you. So we speak boldly on your physical wellness. We come into your organization or your social circles, your groups, company, and speak to you on physical, mental, financial, social, spiritual, environmental, and intellectual wellness. Now, those are the 7 main pillars around wellness, whether in the workplace or in your social circle. So we also help organizations structure wellness programs and train on wellness. We train wellness champions within the organization. Now, our calendar of events that support our wellness programs, we've already done our nature walk on 29th, which was at Karura. Amazing. Last month, we did our team building and networking event at the Children's Park. Now, this month, we are doing the physical wellness event. That is on 31st of May at the Children's Park again, Nyerere Road, just next to Serena. Now, June, we'll have the environmental wellness activity, a hike in July, facing our fears in August, movie and bowling in September, mental health awareness in October, and we culminate the year with a dinner and awards for wellness champions. So we encourage CEOs and business leaders to develop, to motivate employees also in wellness and also become our wellness champions in your organizations. That was our event last month, and we hope to see you this month as well. We invite partners to come and be with us as we promote holistic wellness in the workplace. Now, today, our topic is demystifying tax relief, exemptions, and pay calculations for employers. We have an amazing guest. When I think of tax matters, I can't think of a better person than my very good friend, Fred Waswa. So we invite you today to a virtual discussion on tax-free leaves and exemptions for pay as you earn and pensions. And we say this will improve the take-home pay. I know our guest will take us through this. Allow me to introduce him today. Our guest is Fred Waswa, the founder and group CEO of Octagon Africa Financial Services Limited, a firm specializing in pension scheme administration and actuarial services, insurance broking and training in Kenya, Uganda, Zambia, and Tanzania. He is a seasoned pension expert with over 30 years of experience, with 20 years of this being in senior management positions. Now, Fred has greatly contributed to the growth of the pension industry. He is credited for being instrumental in the formulation of the Retirement Benefits Authority regulations in 1999. Fred holds a Bachelor of Science majoring in Statistics and Computer Science from the University of Nairobi. He is also a certified trustee, trainer, and examiner by the Retirement Benefits Authority and has presented pension papers across different platforms worldwide, notably at International Conference on Employee Benefits in London, Federation of Kenya Employers Forum, Association of Retirement Benefit Schemes, Association of Pension Scheme Managers in Addis Ababa, Institute of Certified Public Accountants of Rwanda, and East Africa Community Central Bank's Pension Workshop. Now, Fred is the author of Retirement Benefits Handbook published in 2015. So we have the right person in the room. We have the right person in the room, and I know there will be a lot of questions. Fred, I know you can now switch on your camera. Fred is an amazing, amazing person. Amazing. And as I said, I can't think of a better person to walk us through this conversation. So Fred, the floor is yours. We want to learn and relearn. Karibu sana.
Thank you. Can you hear me, Esther?
Very well, very well.
Excellent, excellent. Thank you very much, and good evening, colleagues and friends that have joined this program. I'll be able to make my presentation today, but before I do that, as I ask my colleague who's an expert in tax that's joined us, Silas Ojambo, if you can be able to post my slides, I'll be grateful. We run a company called Octagon Africa Financial Services Limited. We are in pension, in insurance, and training. We do pension administration for occupational pension schemes. We establish, we run, we dissolve schemes. Just for those ones who wish to wind up, we do winding up, we do liquidations of schemes. We also in actuarial work, we do actuarial evaluations for pension schemes. We do evaluations for gratuities, and we also do training. And training, we do training for occupational pension schemes, for trustees. We do training for umbrella schemes in terms of committees that are running umbrella schemes. So that's who we are. We are also doing insurance broking for all insurances across the four African countries that we are established in. So thank you very much. Silas, if you can put on slideshow, that will be a better presentation.
I hope you can see.
Yes, put on slideshow. No, down there, the
Yes.
Okay. Okay, so thank you very much, Silas. Silas is a tax consultant that will be coming in to help from time to time as we go by this program. We're talking about demystifying tax reliefs and exemptions and pay as you earn calculations for employers. There has been a lot of discussion around this on social media, especially when I think the finance bill was released a couple of weeks, I think 2 weeks ago. It's I think a week ago. Today, I think they published the first version of the finance bill, which has a slightly a couple of some slight differences, but not major. But I think we're waiting for the green version, which is normally the last version that goes to Parliament, which hopefully will have the same matters as we discussed today. Now, there are tax reliefs that are provided. If we can just go to the second slide, the next slide, to Silas. So we have pay as you earn is a tax system where employers deduct income tax from employees' salaries and remit it to the Kenya Revenue Authority. Now, there was a discussion around pay as you earn is going to be now deducted by the employers and not employees seeking refunds from KRA. Ideally, that position is only correct for those employers who are employers for United Nations, for embassies, who are getting full salary and paying taxes on their end, and therefore can only claim if there is anything needs to be claimed from KRA. So they have to claim relief at that very particular point if you don't get taxed at source. All employers, both parastatals, government employers, and private sector, you are required as an employer to be able to deduct pay as you earn at source and pay to KRA, and therefore tax relief is given at that very particular time. It's not claimed at the end, maybe at the end of 1 year or something like that. It's basically given at that time, pay as you earn. So when you, for example, on a pension contribution, today, if you're earning 100,000 shillings, and we'll see an example, you're earning 100,000 Kenya shillings and you get, you are contributing 30,000 Kenya shillings, you are getting a tax relief on that. So which means that if it was 100,000 shillings and pay as you earn, for example, is 30%, then it means tax would have been 30,000 Kenya shillings. But because you are paying 30,000 Kenya shillings, so therefore the taxable pay becomes 70. Therefore, the 30% of 30,000, which becomes the tax relief, comes to you at that particular time. You don't claim it at the end of the financial year end. So that needs to be clearer, that what was being talked about was not necessarily for employees who are the majority, who are basically the majority. The minority who are a small team, a small group of people who basically don't pay away. And I think the government has been trying also to change that so that whoever it is, they must deduct pay as you earn at source rather than giving you all salary and you pay as you earn from your end. So effective July 1st, 2023, the individual income tax rates ranging from 10% to that 5% are applied as graduated income bands provided by KRA. So this changed, moving from 10 to that 5%. Previously, it was 10 to 30%, but now it moved on to 10, 35%. Of course, I think 500,000 Kenya shillings, 30%. Then if you go to, I think 800,000 shillings, then you have 32.5%, and above that 800,000 is 35% that is applied to salaries at that particular moment. Employers have the responsibility to register for Paye with KRA, deduct tax from employees' emoluments, remit the deducted tax to KRA by the 9th of the month, and file monthly PAYE returns via iTax. So these are the PAYE requirements. So if we can go to the second slide, Third slide. Yes, yes. These are the items that affect the tax payable by each employee and include tax reliefs, non-cash benefits, exemptions touching on both reliefs and non-cash benefits. So we have tax reliefs, we have non-cash benefits that are provided for, and we have exemptions touching on both reliefs and non-cash benefits that we want to discuss in the next slide. So next slide. So the applicable tax reliefs and exemptions are, we have personal relief, which is 2,400 shillings per month or 28,800 annually for resident individuals. So each one of us, we get a tax relief of 2,400 shillings per month on our pay, and then insurance relief is at 15%. So if you have a life insurance or health insurance or education policy, you'll get relief of 15% of up to 60,000 Kenya shillings per year. Shift contributions, which are 2.75% of gross pay, are deductible in determining taxable income. So which means that if you contribute shift, all of us, not if, our shift contributions are tax deductible. So if you have a salary of 100,000 Kenya shillings and your shift contribution is 27,000 Kenya shillings, then it means that 27,000 is removed from your taxable pay. 2,700 is just moved from your taxable pay, and then the balance is what is taxable. I think that gives quite some money coming back to our pockets at that particular time, because when shift was not tax deductible, it meant that basically we are just losing all the tax relief that is provided on that very particular basis. Now, if in our life insurance, health insurance, and education policies, it's up to 60,000, which is 5,000 per month. Yeah. If we can mute, yeah, that's fine. Thank you. And then post-retirement medical fund relief is 15,000 shillings per month. It's deductible when determining taxable income with effect from December 2024. Now, the government has allowed pension schemes and organizations to set up what we call post-retirement medical funds, where employees contribute more and above the retirement benefit contributions, and those contributions will go towards either setting up a fund for them to use at retirement for purpose of paying medical premiums, or setting up a fund at the end of their retirement. The organization can organize for a medical scheme that where they will be able to get benefits from. Now, those contributions that are over and above the pension contributions are now provided tax relief of up to 15,000 Kenya shillings per month, which is a good thing again. Therefore, it means that if you pay 15,000 shillings pension contributions, post-retirement medical contributions, then you are taking home a little bit more money, rather than paying tax on 15,000, which means you're not paying, because post-retirement is not compulsory. It's one that you can decide or not, or to contribute or not. Then we have pension relief. Pension relief is on contributions, which is 30,000 per month, or 306,000 shillings per annum of individual income contributed to a registered pension provident individual retirement fund, is deductible with effect from December 2024. So with effect December 2024, the government increased the pension relief from 20,000 Kenya shillings to 30,000 Kenya shillings per month. That also again gives you more money to take home. So I say that, look at this: if you are earning a salary of 100,000 shillings and you decide to take a pension, an insurance policy, or a life insurance, or a health insurance policy, and therefore you get 5,000 Kenya shillings in terms of relief, and then you take a post-retirement medical, you get 15,000. That is 20,000. Pension relief is 30,000 Kenya shillings if you are contributing with the maximum of 30,000 Kenya shillings. So you have 30, you have 15 plus 5, that is 20. That's 50,000 Kenya shillings. So if you have a salary of 100,000, you're contributing all these 50 in these three schemes, then you're only taxable on 50,000 Kenya shillings. So you have reduced your tax obligation in a large form. So we need to encourage our employees to basically do more contributions in pension schemes, do more contributions in post-retirement medical, and basically set up life insurance policies or medical health insurance policies, because that helps a lot more. Now, if you take a mortgage, because the government is trying to encourage more people to be basically to take mortgages. If you take a mortgage, there's mortgage interest deduction up to 360,000 per annum for interest paid on loans from specified financial institutions for purchasing or improving residential premises. Then you get a tax relief. So if your interest is so that's about 30,000 shillings per month. If your interest is 30,000 shillings per month on your mortgage, then that 30,000 shillings is deductible. It's also given tax relief in terms of deductibility. Now, the amount deducted as affordable housing levy is also deductible when determining taxable income. Now, housing levy SHIV are deductible 100%. So which means that the whole amount that you are basically contributing is deductible 100%. It's just like NSSF contributions. So of course, NSSF contributions get deductible as 100% from your pay. And then the balance will go into any other contribution that go into a pension scheme over and above the NSSF contributions. So NSSF, we're talking about tier 1 and tier 2 contributions combined together are deductible 100% from tax. And the next slide. Now, non-cash benefits and exemptions, these refer to benefits provided by an employer to an employee in material, not cash form. They are meals provided by an employer up to 5,000 shillings per month or 60,000 per year. These non-cash benefits are of course they are tax deductible on the employer side in terms of exemptions. And night out allowances of up to 2,000 shillings per day. Currently, there is a proposal to increase it to 10,000 per day. We are hoping that should be acceptable. Of course, I think it's part of the proposal that has come through into the bill. The medical cover provided by the employer, of course, if the medical cover provided by the employer, the premiums paid, of course, tax deductible on the employer side. Then pension contributions by the employer to a registered retirement benefit scheme, of course, within the liable limit of 30,000 shillings. So the pension contributions, if the employee does not cover the full 30,000 shillings, the balance, the employer takes it up as a tax deductible when they are computing their profit for purpose of determining tax. The next slide. So some more computations for this in terms of gross salary of 200,000 shillings, allowable deductions, a mortgage interest of 10,000, for example, if interest is higher, allowable maximum is 30,000 per month. So if the pension contributions are 5%, which is 10,000 Kenya shillings, allowable is 30,000 shillings maximum. And then we have housing levy, which is 1.5%, which is 3,000. SHIF is 2.75%, which is 5,500. It's 2.75% of 200,000, not 100,000. So that becomes 5,500. Then taxable pay is Kenya shillings 200,000 minus 10,000 plus, of course, minus total of 10,000, 10,000, 3,000, 5,000. You get 171,500, which is taxable. So you have savings on it of almost 29,000 Kenya shillings, or 500 on that. So pay as you earn calculation in the first 24,000 at 10%, which is 2,400. The next 8,333 at 25%. And remaining is 134 at 30%. So total pay as you earn becomes 44,937. So out of that, you less personal relief of 2,500. There's no insurance relief, assuming no insurance policy has been taken, and therefore the net pay becomes the net pay PAYE is 42,537. So you can see if just go back again. So you can see if if somebody, let's say, increases their contributions, because this where you can only make a difference is on pension contributions. SHIF is compulsory. SHIF is compulsory. Housing levy is compulsory. If you can take a life insurance, you of course again increase your tax reliefs, and therefore pay less, pay as you earn, and take home more. I know you may not necessarily be taking home the money, but you are paying less pay as you are paying less pay as you earn, even as you you put aside your money, which is your money at the end of the day, because pension contribution is your money. If you take an insurance policy, it's your money. If you take a mortgage, it's your money. So all these things basically is your money you're putting aside, but on that they are saying we'll give you relief on that very particular savings. Yeah. Next slide. So then we have allowable deductions in terms of pension contributions for 3,220. This is for NSSF now. In terms of housing levy is 1.5%, which is 3,000. I think we have looked at the SHIF. We have looked at that. I think we have looked at the example of that becomes 187,180. So this what we have done is to look at this from an NSSF perspective. So the scheme in this, we are assuming you don't have a mortgage, but your pension contributions you're only doing up to 4,320, which is the maximum in year 3 this year for NSSF contribution only. So you can see that your taxable pay is higher, because 187 compared to 171,000 Kenya shillings. Why? Is because your NSSF contributions, your contribution to pension schemes are lower. If you desire to pay 10,000, which means 4,320 goes to NSSF, and the balance goes to what we call tier 3, then you have your take-home your taxable pay becomes lower, which is 171,000, and therefore your PAYE becomes less. So you need to look at that. You need to help our employees to be able to understand that the more they save, the less they pay PAYE, the more they take home, in quotes, in terms of what you have today and what you are saving on the sideline. So that's basically what is shown in this very particular computation. Next. Yeah, thanks very much. So that brings me to the end in terms of how the computations are. I would like to request Silas just to be able to give us a synopsis in terms of what's happening again also in the bill for 2025, and then we can now be able to address the questions that have been posted. Thank you.
Thank you so much, Bonafred and Esther and the rest of the team. I hope everybody's hearing me.
Yes.
We can hear you.
Okay, thank you. I just wanted maybe to highlight 1, 2, 3 things. Majority of the basis of all the explanation I've seen here, Fred has based entirely on employee. But I want also to bring in an element of same on the employee alone. For example, now that we are trying to file our returns, number one, you will end up finding that our return systems from iTax have really changed. They are coming in when you are filing your returns. For example, if I may just take 1 or 2, 3 minutes in respect to this, you need to take your P9, and your employer needs to enhance that P9 to have elements of all the deductible items, because, for example, SHA is only allowable to claim in the year 2024 between October, November, and December, as compared to housing levy, which is starting from April. So you need to understand those elements. And number 3, you also need to understand the essence of what Fred has been talking about the tax reliefs. Tax reliefs, as maybe if I may revisit what the president said the other time, I think we are in a political environment where we want to hear everything, but in a nutshell, there's no change. The only thing is when the president said that if you want to get these reliefs or these exemptions, you just need to write directly. What he was trying to say, KRA has devised their system whereby he is encouraging all employers to re-register for these items as they outlined from housing levy to SHA, because when you do re-registration and validate your systems, when your employer tries to load those things, it already affects your iTax portal. At the time of filing, for example, on 1st of January 2026, the return for 2025, you will not need even the P9 from the employer, but it's good to have it because you have to confirm what is have been billed there. So you will only go directly to iTax portal and say, maybe if you only have an employment income, that I want to file under employment income only, it will bring entire items you want, and you'll file easily. Number two, in case there is an element of making sure that you want to make your tax obligation easier. Number one, if I may talk about an employer, employers are also affected or are also beneficiary of all these elements we are talking about. The tax reliefs, for example, housing levy. Before, employer used to claim only 100% of the employee salary. But because the introduction of these other elements, the government had decided to also include as part of allowable expenses that the employer are going to benefit. So it also allows you to reduce your tax obligation. Then if you go to the entire things which have been mentioned, all of them, from relief, insurance, pension, post-retirement benefits, mortgage interest, all these items are beneficial. As much as we demonize them, that are expensive to us, the government has tried to balance the effect for both entries between the employer and the employee. Maybe I'll suggest you need to get more emphasis on how you do these returns. And number three, for the employers, what I wanted maybe to discuss more about is about employer filing this employee emolument. There are employers who end up filing salaries and emoluments for employees who are above the bracket of tax, or who are within the tax bracket, but leave out those employees who are outside the bracket. I mean, those who are earning less than 24,000. The tax system, especially the iTax, is so sensitive that anything from 1st of January 2025, and that is still within the new proposed bill, that you will not claim any expense when it comes to salaries to your employee, to your company, as an expense at the end of the year when you do your audit, if you will have not included that amount in your pay as you earn returns on a monthly basis. Because what happens is, going forward, they will only run iTax returns between January and December. Anything outside that will completely be disallowed, irrespective of the explanation. Because the system, how it has been generated now, is not like before. You only need to claim what has been filed. So anybody who is earning even 10,000, for example, within a month, you need to get details from PIN number, his details, put as part of your payee. That allows you that 10,000 to be an expense to your company. If you don't, then 10,000 will be disallowed, but you will have paid for an expense, which is completely unallowed. Maybe if I may leave it from there, and in case you need more details, we will provide the details for any education you need, from registration, e-teams operation, and other related tax obligation requirements. We are there to help you. Thank you. Appreciate it.
Thank you very much. Back to you, Esther.
Thank you, Fred. Thank you, Silas. I see we have 33 people in the room. I want to open the floor. Anyone can unmute and ask a question. Today we are here to learn from the experts. Agnes, Amina, Beverly. I see Victor has posted a question. Jane Mugo, you unmuted, did you?
Yes, Yes, good evening, and thank you for the presentation. Now, my question is to the tax experts. When you have employees who are secondary taxpayers, do they still have to contribute to affordable housing and SHIF?
Maybe if I may come in, maybe just to answer that question directly.
Yes.
The law now provides that any income in Kenya, any income, be it a secondary employee or not, it's mandatory, is subjected to SHIF and SHA.
So it doesn't matter whether they are paying that in another salary.
Actually, what is supposed to be done, you're supposed to consolidate the entire payment.
Yeah.
And
Okay.
you do, yes.
Okay. Thank you.
Appreciate.
Good. Thanks. Lucy, I see you unmuted. Lucy Kamau, or is it?
Hello.
Hi.
Hi, how are you?
Very well, thanks. You can ask a question.
How about taxes?
Yes? Yes,
Regard
taxes. Yes.
yeah. So my question was, hello.
Yes, we can hear you. We can hear you, Lucy. Just proceed.
There are employers who employ you and then on the payslip you don't see the relief featuring there. And considering that previously maybe you've been employed somewhere and it has been featuring and you could see effects of it. So I wonder why certain employers don't have to have that relief featuring there. And when you try to do your math, it doesn't add up. Maybe you can clarify on that.
Sorry, if I may answer that question, if she is maybe a bit clear, I wanted to get her, from her. Is it that the current employer is not giving the relief in terms of personal relief per month, or which specific relief are you talking about?
Initially it used to feature, like you could see, like after the deductions and all that, the remittances that you have to be remitting maybe in the organization, you will see like the calculations would have that like really featuring somewhere, meaning that as much as all those deductions have taken place, something is supposed to be like less tax. But when I don't see it now, I don't know what to think.
Sorry, maybe if I may ask, sorry, by answering, are you a permanent employee or maybe a structural employee who comes with a certain period and you leave?
Normally, okay, we contractual, but long term, like it's more of permanency unless you wish to resign or and the organization probably finds you with a fault. But we have people who've stayed there under the same like employment terms for close to 20 years, 21. So I would say that it's more of a long term thing.
Okay, maybe if the best thing maybe I can tell you is that you need to ask your employer or your payroll department that on monthly basis you need a documentation to support all the proper deductions that you have been provided by the employer on your behalf. And at the end of the day, the other thing you also need to understand, if you don't see those transactions and your employer seems not to provide the proper information, you have a leeway to write an email to KRA at call center, or you can visit any of the KRA station and find out more details about such a kind of employer, but that will be amounting to putting your employer into trouble. The best thing we always say is you as an employee, you have an active PIN. Go to your iTax portal, open it, check into iTax portal. Is what is being remitted on your payslip as Paye, is it exactly what is being remitted? Because once
by 9th of every month, every employer must have paid, because that's the deadline. So every 10th of the month, check, is that pay remitted as per the required? Now, if you still have a challenge, that's the reason why I said you need to consult someone who is prior to all these tax issues. Then he can be able to do a recalculation for your pay and check if all those things are correctly structured. Or else also you can go to internet and check under Google. You can say pay calculator. You feed the details of whatever you need and you counter check. Is that exactly what is being provided? And is that what you need to have? I hope I have answered your question.
Okay. Thank you.
I appreciate it.
Thank you. Let's who else would ask to ask a question? I can see quite a number of people unmuted. Kate, Nelly. We can use the raised hand so that we go in that order.
Some questions on the chat.
Yes. Lucy, I think, has asked, yes. I think that's all. We can go to the chat maybe as we wait for. So Victor is asking, when computing final dues, severance pay, notice pay, and accrued leave of employees terminated on account of redundancy, is the employer required to deduct NSSF SHA housing levy apart from the pay? So maybe Fred or Silas?
Okay. You said on if on termination or on retirement.
No, account of redundancy.
Okay, on account of redundancy, this is still an active person in employment. That's what it still remains. So if you're still inactive, the other deduction still remains. You will have to be deducted all the items because you're still an active employee. I mean, everything is. It's okay. Fred, you can call.
Go ahead. And finish it, and then I'll come in. Yeah.
Yeah. So I was trying just to identify those are gray areas whereby now. For example, if you worked for an employer for 20 years and you still have 10 years to retire, for all those, it's like an income you are going to earn at that period, because that amount can only be subjected outside the tax and all the other relevant deductions once you reach the retirement age.
Correct. You know, any income that PAYE is applicable, NSSF, SHA, and housing levy are also applicable. Any income where PAYE is applicable. So if the employee, if it's a redundancy, which a redundancy PAYE must be applicable, then NSSF, SHA, and housing levy is applicable as well. Yeah.
So I hope that's clear, Victor. Good. Okay, then we go to Peter. Peter is asking, as a tax expert, do you see the housing levy being valid? Up to when are we going to pay it?
It's like being a prophet.
Maybe if I may answer that question, all of us, we are in a debatable mood. The purpose of that deduction, that's where the problem is. From the world go, Kenyans are very hardworking people. They would have expected everybody to contribute to the economy in a different way, rather than housing levy. Because at the end of the day, all of us, or majority of us, are in a situation whereby some of them are taking loans, some have taken mortgages, are building their own homes. They are taking mortgages maybe to have a property somewhere. There is no justification to tell me or you that you need again to contribute some money to enable someone to get a house. The Constitution of Kenya does allow the government to provide for that service, because the tax we are paying is equivalent for the government to enable them provide those houses for those people who are unable to get those properties, number one. And number two, also the government has the government has a provision within the law whereby they can be able to discuss with the Central Bank of Kenya, discuss with the commercial banks to lower rates, whereby every Kenyan can have the leeway to go back to commercial bank, get those loans at a cheaper rate, and have the property. So this is just an additional cost to employees and employers. I would have understood as an expert that all these things were meant just to be another tax. As the last time we had someone from the government saying, this is a tax, it's not a saving. So where is it? Unless maybe another government comes in, we don't know whether they will be able to allow us stop it or not. That is something to guess between me and you. But the experts we have within the ministry, as ISPAC have really voiced their concern about it, because there is no feasibility in terms of devising that law to benefit entirely the purpose of everybody who was in it. So where is it? It remains to be an additional tax.
Good, thank you. Fred, you wanted to say something?
I think you said much. You know, this is a law. Whether it's valid or not, we cannot. You know, we must implement it. Unfortunately, it's a degree. Degree from the government is low. Up to when we are going to pay it until Christ comes back, or another government comes in and amends the law. So we are here just to basically, you know, submit to what the government says. I don't think we have much to say.
Good. I see another one here. How does someone who has been employed by two companies the same year file the return with all the changes that have emerged?
Very simple. It's normally like filing any other company, just as a single. But you see now, when you are putting in those schedules, the first line will be for one employer, another schedule will be for another employer, a second line will be for another employer. The challenge is, and the advantage is, you cannot be an employee for two employers at the same time. And if that happens, then it means one of the employers is supposed to be deducting you 30% of what you receive. Or else, at the time of filing, then you'll end up finding that you have more tax you are supposed to pay.
Wow. You can't be employed by two people.
No, you can't. You can't. What I mean, you still you can. But you see now, when it comes to tax matters, the assumption is both the two payments are what you gross all of them. And you see now the challenge, if there is individual employers filing pay differently from another one, they assume that's the only employment income you are receiving, and they will only tax amount based on what they are paying. For example, if Octagon is paying me 100,000 per month, I expect Octagon to charge me 30% of the 100,000. And then I go to Esther's Katiba Limited. They're paying me another 100,000. I would expect now Katiba to charge me on a pro-rate basis, whereby now if I take the pro-rate base plus the 30% of the 100,000 from Octagon Africa, I'll pay the equivalent tax for the entire month. But in case Octagon charges me on a proratas basis, and Esther also does the same, when I'm going to file my return at the end of the year, you will end up finding that you are having a lot of taxes you're supposed to pay.
Okay.
Or I mean, conversely, I mean, Silas, you are working for two companies, and each one of them don't know that you're working for two companies. So I get 100,000 shillings. I get taxed on from Octagon. 30,000. I get Esther Katiba 100,000 shillings. I get taxed 30%. I'm actually paying more tax than I should have paid, isn't it?
Oh, not at all. Because let us just be on a real sense. If you have a laptop where you are, just go to internet and type calculator, Paye calculator. Put 200,000 and tax it. How much tax you pay? And then put 100,000, tax it separately, and tax 100,000 separately. See the two differences. Then map it on a return for the entire year. You will end up finding that you have more obligation to pay.
You have higher pay. You have to pay a higher tax.
Yes.
Oh my.
Because you see now the reasonability of doing so is, and I think that's the right thing also. That's the right thing. Because what the government expect you is you are supposed to pay as you earn. The word paying as you earn meaning whatever you earn, that's exactly what you are supposed to pay in terms of tax, isn't it? Now, if that's the scenario, you are trying to tell the government that I wanted to hide my face under the sun, that when Fred pays me 100,000, I pay only, let's say 21,000 as tax, then Katiba pay me another 100,000, I pay another 21,000, that is 42,000. 42,000 is not a tax for 200,000. Even if you check the slides here, for example, if I just go down, I hope you are seeing the slides.
Yes.
If I use these deductions the way they are, you know, now for 200 separately, for example, let us now talk about 200,000. 200,000, if you use now the normal segregation rate the way they are, you'll end up paying a pay of 42,537. This does not mean that the 200, if you earn 200 separately and every employer submit by this way, you will only have paid 82,000 or 83,000. Try to put 400,000 on a calculator and see how much tax you will pay. It will be maybe 70,000. So you will have it will be maybe 120. You will have yes.
To be a high amount.
Yes. That's the reasonability of somebody if you are being paid, unless you decide that that will be like a consultancy. A consultancy is different because there would be involvement of withholding. When they does the withholding, then at the end of the year is when now you can recalculate, find out how much you have expense on that consultancy. Then you net as an expense. But the other one will be just like an employee.
Okay.
Wow.
I hope I've tried to explain.
Yes. I want to ask Beverly, which way do you want to go? Which one do you want to do, Beverly? Do you want to do each, or do you want to consolidate? Jen, how can one benefit from the tax relief if you are self-employed or consultant? That is if you still save in pension and have an education policy. How can one benefit from the tax relief?
I think from the way we have done is if you okay, because then you're not necessarily paying yourself a salary, so you basically paying contributions out of your taxable income. Then at the end of the year, when you're doing your returns, you are declaring how much of your money you have paid to a pension. Of course, you need to provide a certificate of tax exemption for the pension scheme you're paying to, and then how much money you are paying for your education policy. You need to do that in the tax returns, and then you'll be able to have a refund from KRA. Which is basically the tax relief. The tax relief in terms of the refund at the end. I mean, I guess that is the right way. Silas, you may want to make it better in the tax language.
I think you are right. Although where I faulted the statement was, being in a self-employment, you are trying to tell the government that you are earning your own business. There's no way you will have a tax credit at the end of the year, because what the government tries to understand is when you pay, for example, AHL, which is housing levy of 3,000, the government assumes you are earning that month 200,000 from your own business. So this is being a business you are earning, it's not an employment. Business for a self-employed is taxable differently. It will not go on an aggregated scale when you are finding the income taxable at the end of the year. What will happen is you take the entire income you have received, less the reasonability of the expenses. Whatever you get as net income, that is exactly what now you subject onto aggregated scale for the entire year. For now, you map it for the 12 months. Then your contribution that you have done for AHL, SHIF, and other pensions, is including the insurance reliefs and medical. Now there will be an allowable expenses that will reduce the tax you are supposed to pay at the end of the year.
Jane, I hope that's okay. Kate is asking, is secondary income, was this answered? Is secondary income subjective to housing levy? Now, since the Paye slab rate applicable is at 35.
We answered that question before, but we can still elaborate. It is an income, and so the governments need for you to provide a gross income for subject of taxes. And as I said, AHL and SHIF are like additional tax. Although the benefit for SHIF is different.
Good. Clinton, good to see you here, Clinton. Clinton asks, what happens when someone has a tax relief from insurance? Is it accounted into Paye calculation?
Yeah, I mean, if you have a tax relief from insurance, okay, first of all, if you have an insurance policy, and it must be either medical, it must be, a life insurance, a medical insurance, or education insurance policy. That certificate gives you tax relief of up to 15% of the premium that you are paying. So, if Paye is being calculated, then tax relief is that relief is removed before calculation of Paye. I didn't understand how the question was asked, but I'm hoping I'm answering it.
I think so. Oh, Clinton, I hope you answered, right?
Yes, I wanted to know is it calculated on a monthly basis or annually?
No, it's given on a monthly basis.
So the obligation of the employee is to submit a tax relief to the employer so that he can be able to do the calculations on a monthly basis when he prepares the payrolls.
The obligation is for the employee to provide certificate of insurance, a current certificate of insurance, and confirm premiums are being payable. So there'll be a certificate of premium that comes from the insurance company that will be used for purpose of providing tax relief.
Right.
Okay, thank you.
Thank you.
Great. Anyone with a question, you can unmute and ask the question. I know we are 7 minutes past time, but we can open the floor for anyone with a question. They can unmute and just ask the question. Do we have anyone? We don't want to lock you out. So we can assume that it is well understood. So then, Fred, I want to thank you for coming in, but I would also want to ask how we get to what Octagon does and how we get to reach Octagon.
You can reach us, of course, on info@octagonafrica.com. If you go to www.octagonafrica.com, you'll be able to get to know what we do. You can reach me directly. I think I don't know if I can put my number on the street. That is 0724 471 and 821. and they'll be able to support you. For those who are
0724, sorry.
0724 471 821. Those ones who want to contract out for NSSF, we will support you through the process to make sure that you can contract out of NSSF to an umbrella fund or a personal pension plan or your own scheme if you are running a scheme today, so that you can integrate contributions to manage cost of pension. Those are the services that we'll basically provide for you. Yeah, so our website is www.octagonafrica.com. You'll be able to reach us in that very particular perspective.
Amazing, amazing. Thank you very much. Thank you, Fred. Thank you, Silas. I think there's a conversation that is ongoing, and especially with the many questions we have. I know Octagon will answer those questions anytime.
Yeah.
Thank you, Fred, for making time.
Thank you very much.
I know we've ambushed you in your resting time, but you are more than willing to support us. Thank you, Silas. And thank you everyone for this evening. God bless you and enjoy your evening. Thank you.
Thank you very much. Bye-bye.
Bye-bye.
Bye-bye.